every few years, I get less. Okay, what's next? And what else can we do to make things more exciting? And like I said, if you do something really well and you have a little bit of luck or a lot of luck, right, then I think it just comes together.
Vinod, thank you for joining today. There's this whole conversation around that startups are finding it very difficult to raise money. At the same time, we are seeing a lot of startups raise money. Most startups today would look at capital, an alternate way of raising money rather than just venture equity funding. So tell us, one, about what is the trend that you are seeing, and second, just give us an understanding of the venture debt market, and what are you doing at Alteria?
Sure. Thanks for having me on this show, Shradha. I think you're right. These are fairly crazy times. And I think the need for capital is the most acute right now. While there is a fairly overwhelming need for capital, I think it's also important to distinguish between what may be appropriate for what kind of companies, what kind of situations. Because you can take a lot of equity and it will be suboptimal, but don't kill the company. But if you take a lot of debt, then it can actually kill the company, right? So one needs to be very careful, both founders and lenders alike, in figuring out what the right fit is. So I think end of March to maybe end of May was largely just figuring out what the portfolio needs, and we were in firefighting mode, which I guess is true for most of the ecosystem. But since June, I think there's been a lot more understanding on what's working and where the damage is most heavy. So we've also been able to calibrate and figure out, what are the newer areas in which we can participate and help provide more capital to companies and so on. So some sectors are clearly opened up as getting some tailwinds, and there are more deals happening there. So I would say there are three broad splits. There are some sectors which are fairly badly hit, which involve any kind of physical community, which involve interaction necessarily for the way the business is done. And this could be across travel, hospitality, offline retail, and all of those are going to take a long time to recover. And we are seeing low to no equity interest in those spaces. So consequently, I would say from a venture debt perspective, also these companies would be slightly difficult to target right now. Then there's an interim bucket where it's a wait and watch, where there are good companies, good teams, but the pace of recovery or growth is still not very clear. And I think there the companies are being tracked very closely, but people are not ready to take a decision yet, unfortunately. And that applies for debt and equity in some form or fashion. The only exception I would say is if there have been prior relationships. And for example, if I'd found a founder before and we've not had an opportunity to work in the last few years, but they happen to fall in that bucket, then it becomes a little bit easier because there's history and there's a good base to start from. And then of course there's the top bucket where you have tailwinds hitting some sectors, which are very obvious now. And we're seeing a lot more deals happen here. There's a clear flight to quality within these as well. So it's not just if you're an edtech company, everybody wants to give you money. I think it's to show that you're a good edtech company and you're showing some differentiation. And there's a reason why companies are attractive, and it's not just the market. And they show that they are kind of pulling away from the pack. And I think that is being tested. So debt overall, I think is being used, or a lot of founders have realized that, when I used to tell them it's insurance sometimes, and it's like extra oxygen that you get, never more has it been true, right? So a lot of founders, and we had actually a rash of deals leading up to February, March. A lot of our companies raised more capital. I think all of those companies are now sitting pretty because they've raised a fair amount of capital, both in terms of equity and debt, and they don't need to look to raise money in the next 12 months. And I think that's the best thing for a founder. They don't need to go to the market. And ironically, they're all getting inbound interest, right? So these are the companies which get inbound interest. Like, the blocks keep adding up. And when you don't want money, when you don't need money, is when it comes pouring to you. So that's what's happening.
Just give us a little more insight on what, like you said, physical communities or sectors which are getting affected. Just tell us a little more on, from a broad spectrum perspective, which are those sectors? Because we've seen investment happening across, right? Across sectors. So abhi kis sectors mein ज्यादा इफेक्ट दिख रहा है?
So straightforward sectors are travel and hospitality. So those two, broader travel, hospitality, anything to do with those, any ancillary sectors related to those, I think have been pretty badly hit. And not only hit, I think it will take at least 6 more months to figure out, what is the recovery path. It's not even like you can estimate today. Within travel, like there's micro mobility, which is still looking interesting because people will need to find solutions for that. But anything around air travel, and vacations, holidays, all of those have been very badly hit, at least for some time. Offline retail is another area. It's only recent that malls have opened. A lot of disruption has been seen in offline retail. So a lot of brands and products which were relying on traditional distribution, which were not in the essential category, I think they've also seen a lot of damage. And they are just recovering now. So it remains to be seen what is the path. And Diwali is one kink that we have in India always. There's a fair bit of momentum leading up to that. And I would say businesses have not been able to adapt to minimizing interaction. So if you take even delivery-led businesses across food or products or D2C brands, there have been some who actually accelerated in terms of their evolution, and they've gotten smarter in terms of how innovative they can be in giving more confidence to end users. If you were to order something today, do you feel comfortable placing an order on a particular platform? Who's engaged in the various steps of the order? It could be anything, right? The more visibility you have, the more comfort you have, and the minute you cross the initial couple of steps and place a couple of orders, then you start doing more repeats. So what's happening now, interestingly, is the cost of customer acquisition for businesses, especially which are online, is rapidly reducing, right? So that's improving what we've always wanted to see as vendors is making companies burn less, right? And that's a good sign because it makes business more efficient, and you don't have to throw money to make money, right? That's an important parameter. But it doesn't apply for all. I mean, that's the key. I mean, it's not for all sectors, and it's not for all kinds of businesses. But we are clearly seeing how do you use the fact that customers are placing a premium on trust, and how do you weave that into your own proposition and provide different data points. For example, we have a Rebel where can you see temperatures of people who are processing your food? Can do you have confidence in the kitchens that are processing your food? Then you place a couple of orders and then you come back, right? But there are obviously those who depend on food delivery. If you're single and you've been a city like Bombay or Bangalore and you have 3 months of lockdown, you want food. I mean, you want options, right? So there are some natural buckets of customer demand which are there. But I think even apparel, some of the other non-essentials, we are seeing some interesting behavior patterns. Where customers are buying, they are buying online, but they don't want interaction. They want confidence that whatever's coming to the house is reasonably safe. So however you can establish that, I think there's some improvement there. But otherwise, non-essential physical retail is pretty badly hit. Anything involving physical community is pretty badly hit. So these are all areas which we'll wait and watch for the next few months. See, what's happening now is more a behavior issue, right? So for example, if you take logistics as a space, right? Now, intuitively, logistics should be doing very well, right? Because there's more need for delivery, there's more there's more demand. But within that, it's not like every company is doing well. That's what I'm trying to say. That it depends on who's been able to establish that they are the best practices, they've been able to adapt. And so that's why I took the example of food, where it's not like every food platform is doing well. That's not the case. I'm not even talking about the Zomatos and Swiggies where you've seen the drop in business. But there is a path of recovery, and it's not like every company shows the same behavior. That's what I was trying to get at. That within even these harder hit sectors, you have certain players who are showing that they are more innovative. They are able to adapt to the customer's pulse, and I think that's what these kind of really tough times bring out, right? I mean, it's the fighters who come out and they come punching, and you can see the innovation happening in different areas. That's the best part of the last few months, at least for me personally. It's a massive level of fight that has happened in the startup ecosystem. I think April first week, it looked like everything was so dark and gloomy, and over the next few months, the level of resolve shown has been incredible, and I'm feeling much better. Seeing what has happened over the last 4 months. I'm still
Yeah.
optimistic.
If you can share about what is venture debt, and because there's a perception also that if you're not able to raise money, then you go for
Yeah.
venture debt. So why don't you demystify
Correct.
this whole
That's
venture debt?
that's a great question, and the answer is the exact opposite of that, right? So, and the reason is very simple. If you're not, if any situation a company is not able to raise any money, it means the risk is highest, right?
Hmm.
It means that even a venture equity provider or an angel investor is not seeing this risk as worthwhile to take, right? And they have a high risk appetite, which means it's definitely not good for venture debt, right? That's the first thing. So I think venture debt is an oxymoron, and I've said this a lot because venture and debt don't go together in the traditional sense. I used to be in Citibank before this, like 12, 13 years ago. I was doing large corporate banking. Debt is very simple, right? Last few centuries, it's worked on very simple principles. It's been a very boring subject. And in fact, when I started off my career, I was a marketing guy, and I thought everybody who was ever doing anything in debt was very boring. Right? And here I am, unfortunately, fortunately. But it worked on first principles that if you have a business which has some assets which people can touch and feel and sell, that's one thing. Or if you're generating profits, which again they can touch, feel, and sell, right? Or use every month, every quarter, then you have in the conventional sense a sensible business, and hence you're reliable. The layer on top is, are you the integrity good? Are you a good person? Do you want to repay the obligation? So these are fundamental constructs, or the parameters on which debt has always worked, right? And there's been over centuries. Now you throw in startups, and for startups, as you know, there's no plant and machinery. They're not making cement, or they're not generating power or nothing. So there's no hard assets. They also are not profitable. And India is not a market where you have the Apples and Cisco's and all of these which become profitable in 3 months and 6 months and whatever. Here, after 10 years, also companies don't become profitable, right? Which is fine. The value creation is a different path. So no assets, no profits. Founders who are professionals like you and me, and they go out and start a company. So they're not from the Birlas and the big families of the country, so they can't give like guarantees for them. So what do you underwrite to, and what do you give money to, and hope to get it back, right? So it's a fairly interesting puzzle. The way we are approaching this is, we believe there's still significant value in startups, and it cannot be seen in the traditional way of assets or profitability, but it's in the way they jump and create value. A
Hmm.
series a seed round, a series A round, a series B round, a series C round. Every 12, 18 months, you're seeing a jump in value where somebody's putting money on the table for that price. And the reasons for value can differ. I mean, for a SaaS company, it's different. For a food company, it's different. So the parameters may vary, but the common aspect is they're all growing in enterprise value. They're all raising equity as they grow. So venture had started the proposition saying, okay, you're raising equity. Why don't you take a little bit of that round through debt? So if you're raising 25 crore and you're worth 100 crore, maybe you can take 20 crore of equity and 5 crore of debt, and you save 5% of dilution. And eventually, if you get bought by Walmart for 17 billion, right, and you'd saved 5% earlier, imagine the gains that as a founder you have, right? And that's in a nutshell what the product is trying to achieve, which is, can we help provide a mechanism for founders to reduce dilution when everything else is attractive, right? So that is a key, right? So you need to raise the equity, you need to be in a good market, you need to have a good team. This is not a bailout product, Shradha. So this is not a product which is the last resort. It is the way you can optimize a good situation and make it even better. So for
Yeah.
investors, for VCs, it's very simple that the top 3, 4 companies in the portfolio return the fund. Can they improve the returns on that? So you put 20, 25 crore, can you take a little bit more? And that has worked well for a lot of funds in the Valley where their returns have been outsized, right? In India, one, the founders can use this money and, kind of minimize dilution. The other important aspect, especially in a COVID type situation, which we briefly spoke about earlier, is it provides you insurance. It provides you time. It gives you that extra oxygen which you may need, which you don't know if you have a necessity or not upfront. In February, nobody thought that the rest of the year is going to play out like this. Right? I mean, nobody would have forecasted that. But for startups, every year is tough, and you never know. Given your experience in the ecosystem, go back to summer of 14 or early 15, when you open a PowerPoint deck and you get funding, right? I mean, it was like that. There was no, it was so easy. And then you saw a period where it was tough. So sometimes, as a founder, you have to provide enough time to raise capital, or not be in a position where you're raising money and you're running on fumes, because that will erode value, right? So either it can help add to your proposition, give more muscle, pound harder, and do more and create more value for yourself, for the investors, for everybody around. Or it gives you some buffer, some extra rope, so that instead of 12 months, you have 15 months, right? It's incremental. It's not meant to change your life, right? So
Yeah.
I think the way I see it is, the founder or the founding team, they are the stars of the show, right? The investors, the equity investors, are like the second leads or the character artists, right? So we are like somewhere there on the margins, in this conversation, right? So we are only trying to provide a little bit. Maybe we are like the guys who provide some light on the show, right? So we're trying to make something look more attractive. We are trying to make a company look more attractive, or provide some support. But you need to take it. It's like an umbrella you buy before it starts raining, right? Once it
Yeah.
starts raining, everything gets expensive. Before it
Yeah.
starts raining, you grab it, you keep it. If you don't use it, great for you. If you use it, then you always had it with you. That's venture debt. It's a debt product. It's a monthly repayment of principal and interest, but it gives a little bit more time for founders. And it's not meant for all companies. Also, I'd be the first to say that not every company which raises equity financing is appropriate for debt. Historically, we've seen maybe 25-30% of funded startups would be appropriate for venture debt. And that may seem like an astonishingly small number, right? But the reason it is, again, not so intuitive is, every single company that has taken venture debt is equity funded. So
Yeah.
100% of that, right? So it's a tough business, where you still want money to come back in a short period of time. But we've had a very, very interesting run over the last 12, 13 years that Ajay and I have been doing this together, and across different entities. So it's been a lot of fun.
Yeah. But what I'm hearing from you primarily, if I have to say, is that for founders, they get to preserve their equity, and it gives them a runway before their next fundraise or before their next outcome, right? And
That's
and
right.
and yeah, so that's where venture debt comes. Yeah.
Yeah. And a few more ancillary things also kick in. You create a track record. There's a little bit more discipline in terms of how you manage your costs as a founder. So, for example, if you're running a marketing campaign and you don't have a cost attached to it, how do you know, how much to spend, when to draw the line? If you know that there's a particular cost of capital, you know exactly what your budget is, what you want to achieve out of that. There is a real cost, and you have to give back the money. I think the other last thing I would say to this is, equity also has to be returned, right? I mean, at the end of the day, equity, there's an obligation to return that with some handsome return. But in a market where you've not had exits, it starts to feel like equity is free, right? But that's not the case. There's a very high cost. You raise capital, you know how it is. There's a higher burden on founders once they raise equity. It's just that venture debt puts a real cost to it. It's far cheaper than equity, but it allows the founders to plan. And if you're doing an acquisition, if you're running a marketing campaign, you're making an investment, you're a couple of key hires, and you want to bring them on board sooner. All of these decisions, you can play around with the capital that you have. There's an equity plan, and then you throw in some more debt with that, and then you have a plus plus plan, and that's useful as well.
Some of the portfolios are Dunzo, Topper, Lending Cart, M Fine, Portia, Stanza Living, Bogo, Wrong, and Raw Pressery.
Yeah.
Did I miss something?
Yeah, we've got a lot more. So we've got about 28 companies in the portfolio now. Not all of them have been announced, but one which we recently funded was Country Delight. Normally, everybody thinks that venture capital goes only in tech-heavy companies and so on. This is a fantastic company, which is in the business of milk, right? And milk and dairy products. And this is a business which has done really well during COVID, right? And the realization that you want to have something delivered at home, don't interact with anybody, it is safely managed, safely handled, huge premium for that. So Country Delight is one which we did recently. We did many. So another interesting thing, Shradha, about venture debt is we follow on when companies raise capital, and we give more and more capital. Like the names you mentioned, be it a Dunzo, or a Topper or a Country. All of these, we've done more than 40 deals across about 28 companies. As the companies raise more capital, it becomes a frictionless way to attach or staple a little bit of debt to every round. So in the first example I gave, suppose the next round the company raises $25 million. It's 20 million of equity and 5 million of debt. I mean, it becomes very simple for the founder to put those pieces together. It's like your pro rata equity investors share, they put in 20% of the round, then you put in 20% through debt. You just need one lead of 10 million for that round, and it makes life easier for founders also. So some of the companies that you mentioned, we've done a lot of follow-ons as well, even during the last few months.
If you have to say from a financial lens, right, running it in a very prudent manner, what are some of the behaviors, characteristics that you've seen in companies who have consistently performed? What are some of the practices they follow?
So I think the first one on this one, Shradha, is something that Silicon Valley Bank had kind of taught me. I mean, that's where they are the mothership for venture debt in the world, right? I mean, they are fantastic, and it's a phenomenal global franchise. And the first is to know what's going on. I think for any founder or investor or a debt provider, whoever it is, it's about knowing what's going on. And which is why even for a Series A company, we say, 30 days from the end of the month, do you know what's going on? Do you know what your revenue is? Do you know? And it's not like a vanity metric deck, right? Where you talk about clicks and this and that and reviews and whatever, right? None of that. Hard numbers, how much cash do you have? What money have you generated? What's the movement like? What are your costs? How much are you paying? How much are you getting? As a founder, the test we do is, do you know what's going on? That's the first question. Second is, what do you expect is going to happen? And is that backed by what has happened in the past? I mean, are we like dreaming completely? Which is fine, but you need to have some foundation to that. And is there a logical path towards that? And are there missteps? So you're assuming certain things, and are you having the right milestones to measure your growth? If you want to go from here, say Series A to Series B over a 12-month period, in the 10th month, you can't just wake up and say, okay, why didn't things go to plan, right? The plan has to be tested. And one of the things that we saw with the good investors and good founders is they don't go board meeting to board meeting, right? It's not like every 3 months you show up a presentation and you have a few cups of coffee, give some gyan, and you're done, right? So that's not a good way to engage with a startup. I think the really serious investors and the founders who think have run through very fast, they agonize over these things on a daily basis, on an hourly basis, and it's not like they have to keep reporting the data, but they know. So when you ask a question and you say, okay, how many such customers were there, or in this market, what was the trend? Or every specific deep dive question, usually it has one or two, but if you get the answer, you know that the founder's on top of the game. Right? And the entire prudence comes around that. So it's about A, knowing, then B, what are you working towards? So for example, if you have 25 crore in the bank, but you're burning 4 crore a month today, you can't still be thinking I have 12 months of runway, right?
Yeah.
Or you need to have a path saying, why is my burn reducing? Is it because revenue is increasing? Is it because costs are reducing? It has to be very simple. So that's why I started with saying, I was a marketing guy, right? Through my MBA, I didn't do any finance. So what it means is, A, no jargon. So when I talk to founders also, no technical jargon, nothing. It's all first principles. If I understand what you're saying, great, right? If I don't understand what you're saying, I'm out of here, right? That means that it's not right for me, or I'm not smart enough to understand what somebody is telling me. So the test of transparency is very important. And almost all the good relationships that we've had, it's because that founders have also resonated on that front. And it's not like you need to show everything to you all the time, but one or two questions, if they're the right questions and the answers come immediately, that everything's fine. Then it's okay. Then you take your time. Somebody busy with something, busy with fundraising, busy with a campaign, no problem, right? I have that trust. But if I ask a question and the answer doesn't come for some time, then those are the tripwires that are there, right? So like this, we evolve some practices on what we need to track, what thresholds are important for founders to track, and hard data around it. Cash never lies, right? That's the one thing. So, the reality moves around cash. Everything else, upwards of revenue is a metric that can be massaged in 25 ways, right? So it's impossible to figure out, what's going on. But you cannot do that with cash. You cannot do that with hard revenue. You cannot do that. For example, if I say this is my revenue, and this is my GST. It has to compare, right? So things like that. There are very natural correlations that happen. But how do you put your returns? Where do you put your marketing costs? Where do you put your logistical costs? So that's where people can play around a bit, but you have to spend some time and also kind of help educate founders to say, okay, at the end of it, if you're transparent, it helps you because you attract the right people and you attract the right
Yeah.
capital. And if you ever want to get listed, that's the path. So some of these things are resonated.
One or two people whom you have found very attractive in terms of the way they manage their operations and the way they manage cash. Does any name come to your mind?
Yeah, and good validation for this is companies. Preface to that is, if companies have only seen success, no, it's tough to figure this out, right? So you need a situation where companies have gone through good times and bad times and lousy times. Okay,
Yeah.
only then you'll know if somebody is good at their job and how they respond. One example that comes to mind again is Rebel. I mean, I've known Jaideep for a long time, and I think they've been through massive crests and troughs, right? And it's not been a straight path, and he's the first to acknowledge that. And they've reinvented themselves a couple of times over. And it's important to see that the DNA of the company we maintain. I think that's another thing I give a lot of value to, which is what is the fundamental DNA of a business? What is the fundamental culture? And it's slightly amorphous. I know it's easy to be, it's very fuzzy and all that, but lack of it shows is how I would say, right? If there is no strong DNA or no strong culture, it becomes very obvious over a period of time. It's like a drummer's job in a band, right? Where if it's off beat, then you immediately know something's wrong. If it is on, then nobody really talks about it, right?
But Vinod, you said a very good thing, a very powerful thing. Like you mentioned strong DNA, and what you are also saying that the strong DNA comes when you have seen everything, right?
Yes.
You get stronger
Yes.
and stronger.
Correct. Yeah. Adversity. I think adversity brings people together. It also tests companies and founders. I think that way COVID is doing that for a lot of companies. But when I talked about Rebel, it was even before. What if your strategy is good, but you're not able to grow beyond the point? How do you adapt? How do you bring in new things to the plate? Literally, how do you innovate in a space which is not not doing so well otherwise? And I think that is what tests a founder. How do you manage attrition? How do you manage co-founder issues? Different things. I think test the founder on their journey. And that's one example. Even Dunzo, for that matter, I think for starting with the time Kabir was doing personal deliveries, I think it's come a long way in how the company has evolved. And it's been a tough journey, right? It's been a tough journey. There's been a lot of customer love, but it's not been easy, and it's not been easy to maintain that level of execution. I'm always marveling at how they manage this with the level of intricate execution level issues that are involved. Everybody still loves them, right? And half the time when I'm checking with different people, I'm asking what is the incentive for you to give such glowing feedback? But that's the way. I don't know if you have anything different to say, but as a user, I've seen that there's a lot of customer love, and it's very hard for a brand to maintain over a period of time without throwing money. It's not like they've raised several $100 million and so on, but they've done well, right? And I mean, even like a small company like Damage, which is another company we had funded recently, through COVID has done very well. It's an innerwear brand, and all these D2C offerings, we are seeing a kind of customer behavior, which is it's simple. I can buy online. It comes to my house. No clutter. I'm done, right? Then that's why I said your cost of acquiring customers also reduces if you're doing your job well. And I think that's an interesting next phase for India, where if your CAC is lower, hopefully we can build more sensible businesses.
Can you give us a rough size of how big is the venture debt corpus to be invested in India, and how are you seeing? Do you have any data on how are you seeing it grow year on year?
Yeah, sure. So when it started in a meaningful way, it was almost 12, 13 years ago. Again, in the back of the global economic crisis, right? It's a good time to start a business. Everybody's expectations are zero. And way back in 2008 is when I joined Ajay when it set up Silicon Valley Bank in India. And so it started off very slow. And today you have a handful of players, right? So you have three large players and a few more who started recently. So I think the interesting thing is it's growing as an asset class. There's better adoption across founders as well as investors, more importantly, LPs as well, right? So I was doing the math and I'm approaching my 200th venture debt deal. So it's been a long journey, right? And it's across 125 companies. So today, I would say that in a year, we are seeing upwards of, say, 350 to $400 million of venture debt happening, with about 85% being done through the three large players, which is Alteria, Innovan, and Trifecta. So I think that's a good sign. It's a market which is growing pretty well. There's still a lot more room. If you look at the US, there's about 15% of all venture dollars is through debt. India is maybe 2 to 3% at this point of time. So we have a lot of room, but it's much harder in India for a couple of reasons. One is in the US, it's contract rich. I mean, if something needs to be done, you go to court, it gets done, and it's very efficient. India is very contract light, and you have to rely on relationships, right, completely for anything to happen. Right. And the second thing is India is not a tech-heavy market, by which I mean it's not like you have patents, you don't have IP necessarily. It's value-driven, it's execution-heavy. It's the real-world business. You use technology, but it's the real-world business. So if a business fails, the residual value proportion is not very high. Whereas in the US, business fails, you have a product to sell, somebody else buys it, the debt is still paid off. So some of these differences have implied that the Indian market is a little bit smaller proportionately. It's still, I think, tracking towards almost $400, $500 million a year. And if you look at the corpuses, I think between the three large players, there's easily that kind of capital, and you have a few more who are starting. The last thing I would say on this is the domestic interest from LPs is very, very strong for this asset class. One is you're seeing yields drop in the broader market. Home loan rates have all fallen. It's good for everybody. We are not competing against banks normally, right? So it's either equity or venture debt. Usually banks are not in the fray. So this is an asset class where it's still giving good returns for investors. It's predictable. Every quarter they get their money. It's like, it goes into their bank account. And it's not linked to what's happening in the conventional corporate world.
Yeah.
So what's happening to the Reliance and the banks and the power plants and cement companies has no correlation largely to the startup ecosystem, right? So your listed markets and your corporate bond markets, there's different variables at play there. None of those apply here. Here, the only thing which matters is the entrepreneurial ecosystem good? Is there venture capital dry powder? Are people feeling comfortable about the venture ecosystem? That's what drives our success. So all of these have helped in kind of improving the asset class, and we are seeing more. So we raised, just 1,000 crore for our first fund. I remember when we left previous organization, which was almost 3 years ago to the day. A lot of people thought, we're crazy to go out and raise 1,000 crore, because if you think about it, in 2017, nobody had raised 1,000 crore across equity or debt in India for early stage, right? Apart from the global valley names and so on.
Yeah.
But you got a dream. So we also had a dream, and we said, okay, we'll try our hand at this, and so what? We'll figure it out. We got lucky, and I would say we had a lot of goodwill. A lot of people helped us along the way. So looking back, I think it was a fantastic journey, and also makes us want to do more, in terms of paying it forward and so on. So it's been interesting.
Yeah, you look happy.
Yeah. No, when I talk about, I can go on. I think I really like what I do, and that 2017 phase is important because when you're around entrepreneurs, I mean, I'm sure you have the same feeling. When you tell so many stories and you're around so many entrepreneurs, it's natural that entrepreneurship bug just gets to you, and same thing happened to us, right? And for so long we were amidst these fantastic folks, and the bug was biting, and we said, okay, at some point we have to do this on our own. I don't know anything else to do, so the only thing I knew was to provide venture debt. Very limited skill set. So I thought, okay, let me try and do this, and but at least do it entrepreneurially, raise our own fund, and that's where Alteria was born, and we feel pretty happy that we kind of spread our wings, and people carried us through.
Like, VCs have They have write-offs. Do you have write-offs? Do you had any write-offs?
Everybody has write-offs. No, and that's another good question. So equity is an interesting animal that you can have a bunch of write-offs, but you can have like one or two winners, and it's fine. Everybody's
Yeah.
okay, right? Because you have one flip card, and you know it's fantastic, right? We don't work that way, and that is the other reason that I said earlier that not every equity-backed company is good for debt, right? So if an equity investor funds 10 companies, they write off 3, 4, and 2, 3 do really well, that's fine, right? The fund is good. For us, if we fund 50 companies, 46 to 48 have to do reasonably well. So that is one. And which is why, we're not able to provide this capital to every startup. Frankly, that is the reason, right? I mean, for example, if I'm giving debt returns to my LPs, and I still say, but I'll write out 25% of the portfolio, they'll think I'm mad. Right? Because I'm not giving the returns that equity guys are giving. Right? I'm giving slightly better fixed income returns. Slightly better. If you're getting 7-8% in mutual funds in debt, maybe we'll give 3-4% higher than that post tax. So the proposition is, can you get 12 to 14% in this product? We're not giving 30%, right? So post tax. So venture equity is high risk, write off a bunch, but get a few winners, win big, and everybody talks about you, right? So that's the story there. Venture debt is stay stable, sober, and be behind the entrepreneurs, support them, but try not to make mistakes. Right? So the mantra here is very simple. If a company is going, if I think a company is going to become a unicorn in 7 years, that's an equity story. If I think a company won't die in 12 to 18 months, that's the venture debt story. So we may not be the best judges of who's going to be the next Sonicorn or unicorn, but I can tell you who's going to die in 18 months. Right?
Yeah.
And we keep avoiding those. And hence our write-offs have been very manageable. So in Alteria, touchwood so far, despite COVID, it's at 0. But it's still early. I think it's still 2.5 years. We have some more ways to go. But that's where I said, founders have really supported us. And through this phase, when there's been so much uncertainty, we did provide support to some companies because the business model needed some help and needed some time. But it was, very, very appropriately done, and everybody understood, that we're not a bank. We don't. Nobody gives us money for this. There's no support coming through for us. But write-offs are a very important part of venture debt, and the key here is the investors who funded the companies. What we look to understand is, what is the probability that this company will raise one more round of capital? And if we believe that it's an interesting probability, they will get there. It's like if you have children with rich parents and the children are behaving well, right? There's a good chance that the parents will continue to fund them and hopefully, take them through to college, right? So that is the bet we're taking. We're not betting them for life, right? So we're just saying, okay, will you go from 7th standard to 8th standard, right? One step, and I will get you one more step. And if you have good parents, then they will pay your school fees, right? If you keep studying well. That's really the analogy here. And, to that extent, we play a relatively passive role. We don't take board seats. We don't tell companies what to do. I don't think that's my job, right? I don't think I'm the expert on that. I can be a non-judgmental sounding board for my founders because I'm not in the next board meeting. And sometimes they run it by me as in, this is what I'm thinking. What will be the reaction? Will some investor think that, think this? All of that is fine. But I don't mandate saying this is what you should do or this is what you should do. That's the founder's call. And, we hope they do the right things.
What has money meant to you personally in your life?
So first, it was, like I said, it was something that I didn't understand, which was, I was a marketing guy. So for me, so people and minds were things that attracted me the most, honestly. So that's why I loved marketing. I started my career in ICICI Bank as a brand manager. My dream, when I did my MBA, my dream job was to sell soap with Hindustan levers. Right? So a very different path. And I wasn't looking to investment banks or consults or whatever. So I guess at some level, it was more to just be around people. And, that was my kick in life. I think that's playing out now also, right? But I wouldn't be cavalier about it. I think money should it's important that it doesn't get over you and it doesn't get under you also. So it should be appropriate, right? It should be enough that you're fine. And it sounds a bit philosophical. I don't mean to be philosophical, but it shouldn't be so less that it's a concern. It shouldn't be so much that you're just thinking about that. It should actually be a non-issue. That's the way I would look at it. So the way I look at what I want to do next, for example, when I left my last organization, and like I told you, people thought I was, why was I taking such a risk? And new fund, no backers, all of that, and you're losing cushy, opportunity. And basically, what they're saying is you're losing a lot of money, and all the carry and everything. Why do you want to do something? And it's so. And same way when I left Citibank to join venture debt in 2008, when I did my last exit interview, I was told that you're dumb to do this. Nobody leaves Citibank. To go to wherever, right? So I think my decisions in life have been largely driven by what's the next thing, and is it something that is exciting? And I've always believed that if I do that well, then the money will follow, and it
Yeah.
has, right? And the second thing is if you build good relationships and on a sustainable relationship, I think that also helps a lot. So it's a long answer, right? I agree, but it is, like I said, it should not be so much that you chase it and so little that you stress over it. So it should just be enough that you're fine, and you got to play the game for something else, right? You got to because then
Yeah.
if it's just for the money, then it gets boring beyond the point. It's got to be for some challenge. Could for me the first challenge was how do you even give money to a startup and get it back, right? So that was the first challenge. The challenge before that was how do I understand finance, right? So whole different level. Then the challenge became, can I raise a fund? Will people trust me with their capital? So different challenges. Right now I'm trying to figure out my next challenge. To be honest, I was lucky that I got these opportunities when I was young in my career. I was lucky that there were people around me who felt that okay, throw them in the deep end of the pool and let's see what happens. And it was fun. I mean, I enjoyed it thoroughly. So I think that has been a consistent thing. And every few years, I get less. Okay, what's next? And what else can we do to make things more exciting? And like I said, if you do something really well and you have a little bit of luck or a lot of luck, right, then I think it just comes together. And that's been the approach.